Welcome to Money Conversations with KJ. KJ is a lifelong entrepreneur who's made a lot of money, lost a lot of money, and found his way back again. If you're looking for a sterile how-to, you're in the wrong place. KJ and his guests will walk you through real-life situations told by the people who live them, and they are as messy as they are inspiring. Each episode will offer lessons learned, advice on how to replicate successes and avoid pitfalls, and a new perspective to power your financial literacy. Far from a one-size-fits-all, this podcast can help you build a roadmap to your personal promised land. Milk and honey for some, whiskey and steak for others, and remind you that you're not alone on this journey.
Well, hello everybody. Welcome back to Money Conversations with KJ. I'm your host, KJ, and today I've got a guest here, Mr. Jordan Murrell. Welcome to the show, Jordan.
Thank you for having me.
So Jordan's in here. Jordan's 29 years old. He's in the loan business, right? I don't think you've been doing it very long. You're just getting going?
Correct.
Kind of thing. And yeah, we're going to dig into Jordan's story because he's 29. I love interviewing right there the millennials that are in the middle of it, right? Because I find through conversation that that's the typical age, plus or minus 30 a year, and you're 29, that where people start to take money a little more serious because you reflected back, right? You've already been working 10, 11, 12 years, whatever it was, if you went to work at 18 roughly, right? That, holy mackerel, I've been doing the right things. We don't know what your story is yet. We're going to find out, but that's why I'm very excited anytime I can get somebody your age on the show. So everybody, let's dig in. Jordan, as you come out here, you know, and I was sharing with you before we got started. I love talking about money. Money's great. Everything we do in life almost revolves about us creating some sort of income to create some sort of lifestyle that we all want to live, right? And it's different for everybody, and there is no right or wrong. So for you, let's talk to the people about reflecting at 29. Have you done that yet, or how has your money journey been going so far?
I reflect on everything that I do.
Okay.
I take a look back, and that's the best way to learn. For me, I experience things and then I review them and see how I could have bettered it or see how it went for myself. Looking back, 29, I've looked back at the decisions that I've made. Some have been great, some have not been great. But again, those are all learning curves that we need to accomplish and progress over.
Well, let me ask you this I ask this question just about everybody. I want you to think back as far as you can as your memory, because like I'm twice as old as you, and I can only remember so far back. But at 29, how far back can you remember when you understood what money was? Mom and Dad gave you a dollar bill or whatever to go buy whatever, and you understood, oh, I'm trading this for this, right? How old do you think you were when you realized money and the value of it, what we all do for it?
Probably about 5 years old.
Okay, that's pretty average actually, right? When probably, like, again, those 5-year-olds, I want candy or whatever it is that you wanted, right? How old were you, do you think, when Mom and Dad sat you down and taught you some money lessons?
I think the earliest money lesson that I have was probably about 8, and the real one came when I was probably about 11 or 12.
So what was the lesson at 8?
That you can't spend all the money you get. Pretty much. I wanted to buy all the candy. I wanted to buy all the soccer balls. And my mom was like, I'm giving you money. Where is it going?
Right.
And it was like, well, I wanted these things. I wanted that. And she's like, well, at the end of the day, what do you have to show for it?
So you used the word want, right? And the word want, you have any kids?
Not yet.
Not yet. Well, there's 2 words in life that really are unbelievable. The word want that you start using early in life, you said 8 years old. That's about the age, plus or minus, right? We want things. Later as an adult, we have to realize how to separate our wants from our needs, right? But at 8 years old, you don't have a need. Your mom and dad are taking care of all your needs, so it's not like you got to fend for your needs. But you learned, or we all learn, right, based on what you're just telling us, which is true, and I actually thinking about it, reflecting, yeah, we all learned wants way before needs, and that's probably why we all spend more money and time on wants than we do needs. And then when you get to an adult, you realize you got to flip that. You know what I mean? So that was your lesson at 8. Big lesson to learn. Really big. Again, that will follow all of us for the rest of our lives. And it's not easier said than done, right?
Of course.
Distinguishing your wants from your needs and spending your time, money, and efforts on either one of those. So the next one you said was what, 11?
11 or 12.
What was that money lesson?
That was more about credit and utilizing credit and the money aspect.
So, okay, so she taught you the wants, and then talk to me about what exactly did, if you remember, the credit lesson.
So we had just moved at this point in time. We moved from England to Canada, and we were starting over, and my mom was starting over as well. So she had to build her credit by getting a secured credit card. She was able to get a secured credit card, and then she was able to progress to a regular credit card. That's when we got secured credit cards. Me, my sisters. That's when we really sat down and started talking about the real aspects of money.
That's interesting that you say that, because as you're saying it, the vision I'm having is mom's learning and teaching at the same time, right?
Well, yes, which is awesome because my mom had great credit living in England. She was able to get whatever she wanted due to her credit utilization. Mm-hmm. Coming to a new country, halfway across the world, she had to start over. So when she was starting over, we were at that tender age where we're sponges. You know, right. We're learning new things every day, living in a new country, new weather, everything. So she thought it was a great time for us to sit down and talk about it.
I agree. I mean, to me, we should start talking about money to our kids when she first with you around 8, because we start developing not just our personalities, but our habits, right? And if you develop these want habits all the time, when you get to the money, they're very hard to break. And this is why people struggle with money, right? So the fact that she taught you about credit, how deep, compared to what you know today about credit, reflecting back, without getting into total detail, I'll just say on a scale of 1 to 10, how much did you learn about credit from mom at that age?
Probably about 7.
So a lot of it.
Yeah.
A lot of it that you understand today. And how well do you believe you understand credit, how it works, how we build it, how we use it on the positive and the negative sides?
Quite well. I utilize it pretty much every day.
Okay. Awesome. So for you guys out there listening who maybe struggle with credit because no one ever sat down and talked to you, man, you've got to learn these credit lessons. Using credit correctly. Credit is about leveraging, right? OPM, other people's money, right? Credit can be with credit cards and everything we want to buy today, and what I call a high ticket item, anything over, for most people, say $5,000. We've got to go finance it, right? Whether it be a car, a house. So you need good credit to have good car insurance, your employer on a new employment, right? When they're checking you out and you're filling out things. If you got really bad credit, I don't care what the rest of your stuff is. Having bad credit paints a picture for a future employer. Like, if you can't handle your money, how are you going to handle this job I want to give you? Especially if it's a really good job, right? I mean, if you're flipping burgers, they don't care. But if you're going to go get a substantial job, they want to know that you're a responsible person, and your credit rating is definitely a reflection on that.
That's agreed. I always look at it as your adult scorecard.
Report card.
Yep. Scorecard, yeah. So it's how people will trust you with their money, essentially.
Right.
Like you said, their job, if you're handling money on a day-to-day, they want to know that you can handle your own before you're going to help theirs.
You know, I have 3 daughters, and I tell them all, I says, when they were, well, one's married, 2 aren't. And I tell them, when you're dating, I'm like, you need to get that question out of the way almost in the first date. Hey, what's your credit score? Because that tells a lot about that person. You know what I mean? And they laugh and giggle, but they do it now.
It's valid.
Dad, he said his credit score was 580. I'm like, run. Tell him goodbye. I don't care how good looking that dude is. You're looking for trouble there. But anyway, so tell me, what other money lessons did mom teach you after, let's say, the age 11 or any age, besides the credit and the wants?
I learned a lot of lessons through soccer. I played soccer professionally. And prior to that, I learned a lot of lessons about money and soccer at the same time.
From like coaches or?
Coaches, playing in games. If I played well and scored a couple of goals, I'd get a little bit more money.
Rewards.
Yeah.
Okay, so you're rewarded for playing well.
Yep.
Okay, all right. Again, when people are out there sitting down and talking about money, and I have a phrase I like to say is, we all really need to learn not to go trade whatever. You could trade time for money. You can trade value for money, either or, right? Trading time is having a job, and trading values if you're an entrepreneur. At the end of the day, it's not how much money we all can make, right? It's about how much we keep and put to work, because the phrase I like is make money, make money. That's the name of the game, is make money, because money makes more money than anything. Because money works 24/7, 365. You and I don't, nor do we want to, right?
Most definitely.
So the sooner that we can all learn that lesson, that whatever I do to actually bring money in, it's my job to put that money to work. I tell some of my friends I treat my money like soldiers, and I got to go put them out in the field and go to battle and bring back and recruit, right? So, yeah, do that. So that's called investing. At what age were you when you started to actually do some sort of investing?
I started investing probably when I just got to college, 17, 18 years old. Started putting money away in a life insurance program. So at the time, I was just thinking it was just for my life insurance, but really digging deep into it, speaking with my mom and my advisor, it's more of a savings plan just in case. So they invest that money into the stock portfolios or whatever they need to grow your money at that time. And then it also backs as a life insurance program. So that's when I really started learning a little bit more about it.
So out of college, 18, or out of college, what, early 20s then?
Yep.
Early 20s. Before that, how much thought did you give to investing?
Absolutely none.
Anybody talk to you about it?
Not really, no.
So you got out of college. Who instigated that meeting with this life?
My mom did.
Your mom did?
Yep.
Okay. Any other vehicles have you learned or are you investing in currently?
Yeah, real estate.
Okay.
I started buying real estate in 2020 and also investing in a stock portfolio of my own in 2020 as well. So that's really where I started growing and sending my soldiers out, as you said.
So I'm trying to get to, there's two types of investing, and then I teach this. I have a program that I offer out there, and I want people to understand the two types of investing that's out there. It's this passive investing and active investing, right? There's two different kinds, which just like it sounds, passive, basically hands off, like, your life insurance policy. You're just throwing money in there and then you're letting the pros take care of it and put it in certain vehicles and grow your money. That's passive. Active, stock market is a little bit of both. I mean, day traders are active because they're looking at it every single day. And some people really enjoy active investing, a lot more work than passive investing. Let me just put my money to work. There are vehicles that I recommend when you want to do passive and let the pros take care of it, basically, that are going to be a lot more less risky. The product that you describe is some type of, and there's many types of it, whole life insurance, right? I'm not a fan. I used to be in the insurance business. I know how those work. And if you really read the fine print, almost all of them, they're in what I call an implodable product. They will implode. Now you're young. You still have that same policy you bought a ways back, and you pay monthly on it. At one point in time, understanding life insurance, the premium on it is based on our age. The younger you are, the less it costs. Because statistically, if you're 22 years old, you're not dying anytime soon. You're 22. You should live. Statistically, right now, the life insurance companies know statistically men live to 84, women 87. So if you're 22, they're like, man, this guy's going to pay me for 60 years. He's going to pay those premiums for 60 years. What they don't tell you, that's in the fine print, but those life insurance, not premiums, but the contracts are fairly, there's a lot of stuff in there to read and jargon that most people don't understand, is that every year you get older, it goes up a little bit. Every year, 22, 23, 24, till by the time you reach around, I call it the tipping point, late 50s, mid 50s, where let's say at 22, the premium you're paying, the smaller part goes towards the insurance, the bigger part goes to work. Right? And you've built up this cash flow bank of money in there. Well, you're 55. At 22, your monthly part of that money, I'll just use round numbers. Let's say your payment was $300 a month. Well, only $40 a month is going to cover your life insurance because you're so young. At 50 years old or 55 years old, it's gonna flip and go around the other way. Now you're paying in, instead of $40 a month, it's probably out of the $300, $200, $225. Now it keeps going that direction. What do you think happens when on a $300 a month premium, that the premium is more than $300 to cover your life insurance and no money building? Where do you think that money comes from?
I couldn't tell you.
So what happens is that they don't call you and tell you, hey, listen, this tipping point happened and we need you to pay more than $300 a month. They don't tell you that because when they sell it to you, it's $300 a month for life.
Yeah.
But what happens is, because it goes up every single year. After, again, it's a certain age, depends when you start. But at this example, let's say it's 55. At 55, you pay $300. Well, your insurance is $400. At 56, it goes to $440. At 57, it goes to $500. Right? So they have to make up that difference. You're paying $3. It's actually $5. They take that money from that money they've been growing for you.
Really?
Yes. Now, if you keep living, what do you think happens by the age 65 to 70?
They've taken most of your money.
The bank ran out.
Of course.
And what do you think happens then?
SOL.
They call you up. And you know what they tell you? Trust me, I've been in classes. I've learned all this. It's Looney Tunes. They send letters out and they say, hey, Mr. Murrell, and you're 69 years old or whatever. And you're like, yeah, your life insurance policy, yeah, your bill is due and it's you're up to $1,450 a month. Would you like to continue? And you're like, what are you talking about? Well, yeah, you've been paying $300 a year for the last 45 years, whatever. And then they explained it to you. So now the kitty's empty. To stay insured for the $500,000 or $1 million bucks, whatever that policy was worth, is $1,450 a month. So how do you want to take care of that? You're like, I'm not paying that. I'm 69 years old. I expected to have money, for my beneficiary when I'm done, or cash some of it out. They're like, yeah, no. And then they explain that to you. You're like, well, you didn't tell me that in the beginning. Well, of course not. His sales guy sold that to you. You know what I mean? That's how they happen. Now they have a real popular one right now. It's called an IUL, where they connect it to the index and they tell you there's no downside, only upside, but it still works the same way. And they make money because of fees. Everybody in the financial industry makes money on fees, right? Fees is it. People with 401ks don't understand 2/3 of their money that they save over time goes to the custodian, who's been handling their money for X amount of years. So it's real important when we put our money to work and to know exactly how it's working and not trust anybody with what when a sales guy sits down at the table to you and sell you XYZ, right? They're making money. They're making a living, and they're making a living on your money that you're putting in every month.
Good point.
And especially in the life insurance business for those whole life policies, they make the insurance companies pay them up front. If I sold you a policy for $1 million, my commission on that thing is about $3,000, and you haven't even paid yet.
Wow.
Yeah. So how bad do I want to sell them?
Pretty badly.
Pretty bad.
Yep.
Yeah. Same thing with the 401k. If people really truly understand the 401k, and you can go on YouTube and Google this. 60 Minutes did a beautiful piece on this back when 2008 happened, the financial collapse. A beautiful piece about 401k. And if you truly understand it, and I won't dig into that one, you would be like, I'm not putting my money in 401k. That's the same thing. I've saved for 30 years, and in finding out the numbers that 2/3 of that money that it earned went to the custodian, not to me. Like it drives people bananas.
Right.
Drives people bananas. So my whole point is saying this: investing is vital to our future. We must and have to invest. Where we invest, there's dozens and dozens of places to invest. But for you guys out there listening, we got to do our homework.
Yeah.
We have to do our homework, because the one thing, our most valuable asset that we don't get back is what?
Time.
Exactly. And so if the scenario I just explained with your policy happens and you're 69 years old, do you have time to make that money grow again? No, you're 69.
Of course.
You don't have time. And then they get all pissed off. Then people try to sue them. They go to courts, and the judge is like, you should have read the fine print, Mr. Murrell. Says it right here. And and obviously insurance companies have the best lawyers because they have the most money.
Of course.
Right? And you're not going to fight those guys.
I'm running home to go check out my policy right after this.
Check your policy. Check your policy, because you are doing the right things, think you're doing all the right things with your money, putting it all in the right places. And to have the rug pulled out from you at the end, people literally commit suicide over this stuff. It's craziness. It's craziness. Always be very thoughtful of what your money's actually doing and checking on it all the time. But those industries understand that regular folks, I like to call set it and forget it. You just know it's your monthly bill. You're a responsible guy. You pay it. You move along. I got other things to worry about and think about. I don't worry about that. Because they promised me my rainbow, but there's a pot of gold at the end of my rainbow. Not so. Sorry to bust a bubble on some of you guys or yourself out there. You're 29. You mentioned your soccer, your sports. You learned other things. You had a mentor. Talk to me about your first mentor, and even if you have one now still.
My first mentor was obviously my mom. She was the one that was guiding me through life at the time,
Doing her job. She's mom.
Yes.
She's supposed to, mom and dad's supposed to teach us, get us ready for life, right?
And then after that, my first mentor was my mom's boss at the time. My mom worked at an insurance agency. She was the VP of finance there, and he ran the business. He was the one that kind of geared me towards looking at real estate investing and just the power of real estate and utilizing leverage other people's money, as well as having good credit. So worked with him often on just kind of understanding how to utilize it and grow your value and your net worth via real estate.
Well, and most people with money, whoever, significantly grow money in one of two areas, either real estate or the stock market, and a lot of people do both, right? So absolutely awesome, and kudos to you to jumping in the game, right? And learning, like, you're not going to make enough money just trading time for money. Just your JOB is not going to do it, and you need and want more things in life, and you put your money to work. That being said, and your mentor, and I'm not sure everything he taught you, there's so many different ways to make money in real estate. It's unbelievable. Like, a lot of ways and strategies to do it without any money, to do it with money, combination thereof, OPM, other people's money, so many different ways. So is this your primary focus now for growing wealth, or what do you think is your primary focus to grow wealth?
Right now, honestly, just working at my JOB, enjoying that time. As I said, relatively new, started working within this first year, and just utilizing a lot of the time there. Want to build enough reserves for my wife and I just to have, and then once we're comfortable with that, with our cushion, then we'll start looking to reinvest in real estate and other options as well.
So talk to me about goals. You have goals. Do you write your goals down?
Not anymore.
Not anymore?
Not anymore.
Is there a reason why?
Because I know them. I don't need to see them every day. I am a goal-oriented person. I am a visual person, but actions speak louder than anything else.
Well, action is always what we want to do to get our results, and we have to take action. But I'll share with you one of the lessons that's in my program, which is Harvard did a study back in 1979 on a graduating class. And they took the class and they asked the question, how many of you have goals? And then they said, how many of you write your goals down? How many of you don't write your goals down? 10 years later, they followed up, right? For the only 3% of the class said, I have clear written goals and I write them regularly. 70% of the class just said, I had goals. They just don't even write them down. 10 years later, the 3% who wrote their goals down regularly and followed their I call it roadmap to reach their goals, earned 10 times more money. It's vitally important to write your goals down. Are you a follower of someone like a Grant Cardone?
No.
Who do you follow in the financial circles?
Right now, nobody.
No James. I just listened to him. I just all of a sudden lost his name. But so it's important to follow different credible people that are talking in the money circles to learn.
Right.
Right. I think today with the resources we all have, Dave Ramsey is what I'm thinking about.
Yep.
In order to, we can learn things for free online. Right. When I was your age, I had to go to the library and open up a book. You know what I mean? And some people are avid readers. I'm not an avid reader, unfortunately. I'm an avid internet learner. I love listening to different YouTubes, all kinds of different. I bet I do 30 hours a week on YouTube.
YouTube University, baby.
But listen, it's all free. It's great info. Now, not all the info is correct info, so we got to be careful who we follow, right? Dave Ramsey's pretty credible person. I'm in the real estate industry. He just put out an awesome video 2 days ago that I'm totally implementing. But I knew what he put out, I was following anyway. He kind of just backed up what I was theorizing anyway. But anyway, so my second lesson in my course is goal setting. Because if you were to get in a car right now or tomorrow morning, you tell your wife, hey, let's go to Houston, Texas. Do you know exactly all the freeways, how to get there?
No.
What would you do?
Look it up.
Right. You'd probably, in your car, if you have GPS in your car, you just punch in an address and follow the blue line.
Of course.
Back in the day, you'd pull out a map and you'd highlight, right? You'd highlight the freeways that you're going to take and follow it. Otherwise, you wouldn't get there. You would drive east and you think, I think I'm going east. I'm going to have to hit that place sooner or later, right? But think of your goals that same way. So if you don't write your goals down and have a clear written path how to get there, it's that much harder to reach them.
Well, let me ask you this.
Yeah.
How do you know it's a clear path? You don't know which is right or wrong. You're just on your journey to your goals.
Research. Exactly. Great question. So there's big goals. I mean, goals are, macro goals, micro goals, right? And if you have a macro goal, okay, let me break down how it is I want to get there. How am I going to get there? And if it's a financial goal, let's say it's a financial goal of, I want to create $10,000 a month residual income off of rentals. How am I going to do that? Right? And so you could map that all out and start from the beginning and knowing that, let's just say, in order for me to reach $10,000 a month, I figured out I'm going to need to buy one rental a year that's going to produce $X. And in order to buy that rental, I have to have $X. I'm trading time for money right now, making $X. How much do I need to put away out of every check in order to make this goal happen? See how it starts small? It's just your paycheck, $X. So to create the down payment to go, and then you're in the loan world, right? And you know what it takes to get a loan on an investment property. So now you've picked up one and you're cash flowing 500. Well, I'm looking for 10 grand. Man, I need 20 homes. How long? And it took me, after your second or third one, if you keep going on that path, now you can calculate the time.
Right.
It's going to take me 12 years or whatever it is. If I stay on this path. Now, something else could happen as you're along the way in this path that all of a sudden, I like to say, you turbocharged your way there. Like, hey, I all of a sudden came into this and I'm making more money. I'm now going to reach my goal faster.
Right.
If I start implementing. But you see what I mean by going ahead and mapping out reaching your goal? Because if you don't do that, it's kind of like I like to describe every day when we get in our cars. Like you got in your car 10 minutes ago, whatever it was, I gave you my address and you found a way to get here. But my point is like, you know where you were going the minute you got in your car. You're coming here. Mm-hmm. When was the last time you got in your car just to get in your car and didn't have a clue where you were going?
A couple days ago.
You just go for a blind drive?
Yeah.
Because I say, like, typically we don't go, you wouldn't drive a car blindfolded. We know where we're going.
Yeah.
Right? If I'm going just to the 7-Eleven to get a Big Gulp or whatever, like I'm making a right turn here, left turn there, you know, you're navigating your way to that store to pick up a specific what you want. And so you wouldn't drive your car blindfolded. Why do we want to go through life blindfolded?
Good point.
We don't want to do that. And again, the more that you can break down those goals, create your little mini roadmap to whatever they are, right? Let me see here. Would you consider yourself a spender or a saver?
I would consider myself a saver.
Where do you think that came from?
Our little piggy banks back when I was a little kid, we used to get, like I said, we used to get money and I used to spend it at the time. And then I realized that I never had. So
piggy bank never filled up.
It didn't until we had a conversation about it. So now it was, you can spend this amount and you would save this amount.
So was the saving lesson from mom? Mom said, save your money?
She said, if you want money for later, put it away.
Okay. But that was the gist of the lesson?
At the time, yes.
How do you feel about saving now?
I feel it's the same way. When you make some money, you got to pay yourself first. I always see it as when I work my job, I want to, obviously we all have bills. I pay myself first, put it away, and then I pay my bills, and then I have my wants after that.
Great lesson. I hope you guys really had a great takeaway right there because, Jordan, you just put it in. I couldn't have said it better myself, right? Unfortunately, most people don't do that, pay themselves first, right? Most people pay themselves last, and then there's no money left, and that's why they go around saying, I can't afford this, I can't afford that. Well, that's because you didn't pay yourself first. Had you paid yourself first and put your money to work, then later on you could have the wants that you want. You know what I mean? But I'm trying to get to... young, you had the little piggy bank. The older you get, like if you don't mind sharing with the audience today, where do you park your money today?
Currently, I just have it sitting in, we just have it in a savings account for now.
One savings account.
Yep.
Okay. So that's one of the lessons I teach. Like, we need to save for a purpose, right? We can't just save money to save. At 8 years old, mom said, save your money for a later day, rainy day, they would say, right? Not knowing what yet for, it's just you would accumulate a certain amount. And let's just say round numbers, at 8 years old, you saved $100. You're like, Mom, I want that toy, whatever. It's $25. I can afford it. I have 100. I want to spend 25. Well, that's 25% of what you have. That's a lot to spend 25% on what you have, right? My point is, we need to learn how to save for a purpose. Like, you want to buy more properties. There's a purpose, right? I want to buy property. And if you've done your homework and mapped out your goal, and you're like, I'm going to buy a house for $300,000. I need 20% down, right? That you're going to figure that out, right? And save. So that money should be put in what I call a separate bucket. If we save all our money in the same exact account for multiple different goals that we have, that's called commingling. Not good. Because when you commingle your funds for different things that you're, putting your money away for, you're taking away from a different goal. And then most people, whatever goals are, they're not all exactly the same monetary goal. I mean, a home is a big one, and your down payment could be $60,000 or $80,000 versus, my car's 7 years old. I think I want one in the next couple of years. I need to save for that one too, right? So that's a different bucket. I'm not going to need 60 or 80,000. I may need 3 to 5, type of thing, right? But if you mixed all that in one account, what do you think's happening?
Just taking from up.
Yeah, you never know when you're actually close enough to reach your goal because it's all bundled in there. And when you take out what you need for whatever goal you just hit, you're like, oh man, I thought I had enough to go ahead and reach out of the goal, buy the car or whatever it is. And you're like, no, now I'm another year away from getting that car. And mine's really running ragged right now. Man, I really need one, right? That kind of thing. And then people put themselves in a bad financial position buying something when they shouldn't, right? So I really believe that parking money in different buckets is vital to us growing our money. Does that make sense?
Yeah, I definitely see that.
Yeah. And the thing about it is some people go, well, I don't want to pay an extra $8 a month on another account. Listen, don't trip over dollars to pick up pennies, guys. Don't trip up over dollars to pick up pennies. Yeah, well, I have to do that. If you're with a bank long enough and you have enough money in a bank, they don't charge you anyway. Right. And it's not a lot of money. Typically in the average bank, if you got over $3,000 to $5,000, they're not charging you that monthly $6 or $8 charge of whatever it is. Right. They're not doing that anyway. So don't worry about it. And if so in the beginning, for a few years, you might have that little charge, but believe me, it's going to go away. And if the bank doesn't want to take it away, what do we do?
Go to a new bank.
Exactly. Switch banks. There's plenty of them out there. So that's a great one there that I like to talk about. You're 29. Do you now, or how old were you when you started to think about your retirement?
2020.
A couple of years ago.
Yeah.
What does retirement mean to you?
It could mean a lot of things. I think about that often.
What does it mean to you?
Freedom. That's what it means to me. It means the fact that I'll have enough residual income for my wife and my family that I do not have to work. That's what it means to me. I would want to work, but having the option to not work is what it means to me.
When do you think retirement is and happens for most?
For most, I want to say 65.
Yeah, that's a number that's programmed to us from decades ago, right? The government did that because we get our Social Security check at 65, right? Furthest from the truth. And for a lot of you guys who listen to me regularly know that no. One, I don't even like that word. I think striving for retirement is horribly wrong. Horribly wrong. It's a false sense. It's chasing that pot of gold at the end of rainbow. That's a myth. So strive to be financially independent.
That's the best.
Now, some people say, well, that means the same thing. Yes and no. Because I know people out there that don't work that's consider themselves retired. I'm like, no, you're just unemployed. All right. Do you have enough money to last your rest of your life? Well, I'm getting, $1,000 here or $1,500 there or whatever. I'm like, so you're comfortable to live on $1,500 a month the rest of your life and you're 47 years old? Like, if that's your retirement, kudos to you. And again, I also like to tell people there is no right or wrong answer on the dollar amount to finish life with. We're all different. Some people are very happy to receive $2,000 a month, however they get it, and consider themselves retired. And there's other people out there that say, I need 25, 40 grand a month before I consider myself anywhere near retirement, because that's the lifestyle they either got themselves accustomed to or they want to live, right? Which is a huge lifestyle. Yep. So there's no right or wrong. But my point to this whole question is, when you started to think about it a couple of years ago, what were your initial thoughts? What were you thinking about retirement?
Being financially free.
And what does that mean to you, though?
As I said, enough passive income each month that we deem as suitable to live off for the rest of our lives.
For your lifestyle.
Yeah.
Did you put a number on it?
No, I actually didn't. I didn't.
So we could use that same lesson that I taught you about goals, right? If we don't put a number on it, let's just say, for example, your lifestyle you live today, and I'll just throw a number in the air. Let's say your lifestyle today is $4,000 a month, you and your wife. And you're like, we're comfortable, but I want more, right? Whether it's a nicer home, the paid off home. I know at whatever age, I like new cars every 3 to 5 years. I don't want to drive a car for 10 years before I change to the next one, that kind of thing. I want to go on vacations once or twice or more a year, right? Finding out whatever this number is and putting that number out there, right? And then earlier I used the example of $10,000 a month, right? 120 grand a year. If that's it, then that's what we have to strive for. That's why it's important to create those buckets, right? So if you know, like, I want a retirement, yeah, I got to start thinking about that, which means I got to start doing something different with my money. One, congratulations on thinking about that at 27 years old, because that's awesome. Most kids around that age are like, I got a long way to go. I'm going to worry about that till later, right? But until you really understand the rule of 72, you understand, like, that's not the right idea. Do you know and understand the rule of 72? I
do not.
It said the rule of 72 is compounding, compound interest, and how it works. How money compounds and doubles. Right. And they call it the rule of 72 because we're always either paying or earning interest on our money. And depending on whether we're paying or earning, let's say earning because we want our money to grow. If you're earning 1% on your money, it takes 72 years to double. So is 1% good? No. Because 72 years is like your lifetime. Like you're done. Like I got another 10 or 15 to go. I got no more time to, make money. Or grow money. You can earn money at 72, but you're not really going to grow money at a decent rate at that age. So we have to do the math and say, man, this is why you hear people talking, and even in your industry, you're lending money at a certain percentage rate, right? Our credit card companies charge us a certain rate, right? So at 6%, money doubles every 24 years. So is that good? That's okay. Institutions would lead you to believe that's a great rate of return. If you talk to a serious real estate investor, like 6% is for, crackheads. No good, right? We all need to learn how to earn double-digit interest on our money. And so when you learn and understand the rule of 72, when you're making decisions with your money, when you're investing or you're getting ready to get in debt, understanding whether how fast you're growing it or how much they're going to make on you is vital to making these final decisions, right? Everybody's all in an uproar right now. You're in the business. Like the rates just went up. They hit 6. Now they just dipped below or whatever. They're probably going to go up again in a month, right? I mean, that's a crystal ball we could all talk about, but likelihood they are going to go up by the end of the year. That's a significant difference, in a loan. If they hit 8%, that's double what they were last 6 months ago. Your house payment was going to be $2,000. Next thing you know, for the same exact house, it's $4,000. Like, well, can't buy that house. Took me out of the water. So understanding the rule of 72 compound interest, how it really works, allows you to make really solid financial decisions. Otherwise, what we're doing is guessing. Right. Is this a good decision? I don't know. Write it down. Let's figure it out. It's a math equation. We can do the math on the calculator on our phone in 1 minute. Good decision, bad decision, right? Cash on cash returns when we invest, right? We got to figure these things out. Are these good returns or not? Right? So learning that lesson, which is another module that I teach in my course, is vital. I mean, it really, you'd be surprised how you start treating your money differently When someone tries to, hey, I got this great deal, whatever it is, and then you do some quick math in your head, you're like, yeah, no, bro. yeah, no. Try me again on something else.
I see that often.
You know what I mean?
Yep.
Yeah, so learn that one when you can. Financial independence is a great thing to get to, but the definition of financial independence is when your money makes enough money to pay your bills.
Yep.
They're equal. So my bills are $4,000 a month. I make $4,000 a month. We are now equal. Then you are officially financially independent. I don't have to trade anything, and my bills are being paid. But we go one step further. You know what they call that? We want to strive for financial freedom.
Yep.
That's when you start making, let's say your bills are $4,000 a month, but you're bringing in 12, 15 or more thousand a month. Now I'm starting to become financially freedom because I have a lot more options in life.
Yep.
Bigger house, newer car, more vacations, whatever you want to do. Give it away. People give money away all day long, right? You hear the stories on TV or wherever. Oh, I opened a GoFundMe account. Like 3 weeks, whatever the story might be. And all of a sudden these people got 20, 30, 50, 100 grand. You're like, why are these people giving all this money away? People have soft hearts, and like it's no big deal if a story hits you and you're very empathetic to the story, and you're like, they have a GoFundMe account, honey. I want to go drop 25 to them. I really feel for that family. You drop 25. 25 didn't hurt you. $25. Everything's relative. The millionaire hit him the same exact way. He's gonna, honey, I'm gonna go drop them 25 grand. Boom.
Doesn't hurt.
So, and this happens every single day, right? GoFundMe accounts every day, all day. People are giving money away, but they give money away when they can. And I think we all should. If you follow Tony Robbins at all, he's the biggest giver. He's all about feeding the planet. His new goal is feeding 100 million people a year. He used to start with a goal of, I want to feed 1 million people a year. I want to feed 10 million people a year. I want to feed, 100,000, whatever it is. And now his goal is he wants to feed 1 billion people. And he does that through his workings and getting everybody to donate. We do this, we're going to feed this many people. So he's always giving. I think that's why his wealth is what it is. If you're spiritual at all, you believe in God or whatever you believe in, whatever we give out, we're going to get back.
Of course.
Some people say twofold, fivefold, tenfold, whatever it is, but the more you give, the more you're going to get back. So giving is really, at the end of the day, when you're getting yourself in position. And I believe we're all in a position. Again, you could hear a story and toss $25 to a GoFundMe, somebody you don't even know, but it changed their life.
Yep.
Right? Right now at 29, what would you, looking back, reflecting, what advice would you give your 21-year-old self?
I would buy property in every city that I've lived in playing soccer.
But at 21, you don't have the money.
Yes, I did.
You had the money?
Yep.
Oh, but you didn't. So what'd you do? So did you squander the money? What'd you do with that money?
Saved it. During that time in off seasons, we didn't get paid as well, so I like to have a little cushion,
right,
to pay my bills that was continuing to come. They don't stop. Doesn't matter if you have a job or not.
No.
So I ended up saving a lot, utilizing that, and then just kept it. Honestly, kept it, and then bought property, as I said.
Yeah. So because you had the means to do it, looking back, that would be your advice to your 21-year-old self.
Buy a house, have your teammates rent from you, and continue that journey. I would have had 6 or 7 properties.
Yeah,
at that time.
buy multi-unit, buy 4-plex, 6-plex, 8-plex, whatever.
Even single family, rent
single
the room.
family, whatever you got to do. Just buy Grant Cardone. I follow him a lot. I mean, just buy doors.
Yep.
The more doors you can have, the better, right? Great advice for you guys that are out there, whether you're 29 or 39 or 59, right? It's a great way to build passive income through real estate. Do you buy real estate now for cash flow or appreciation?
Cash flow.
Okay.
Appreciation's going to be a bonus, but I need to make sure that when I'm running these numbers, I need to have cash flow. I don't want to be paying I want to be paying another mortgage on top of what I have.
Mm-hmm. I asked that question because I have a handful of clients that I find investment properties for, regularly, and that's my first question to them. What's more important, right? Cash flow or appreciation? And what do you think most of them tell me?
I'm hoping they say cash flow.
Actually, no. A lot of them say as long as it pays for itself and the money doesn't come out of my pocket to cover all the expenses of owning a property, I'm more about appreciation. probably in the last 6 years, they've done phenomenal. In the last 2 years, they've done amazingly, right? Now, if we actually get into a buyer's market and things go down, likely then the other one works more. But we all know that the rents have gone through the roof.
Yeah.
So if you started, right, and there's no right or wrong answer here, whichever one you want. Ideally, I have clients that they're like, I want both. I'm like, everybody wants both, right? Depending on what market we're in, if we can do that or not, right? But ultimately, if you buy a property and your property can at least pay for itself, right? All the bills, the taxes, the mortgage, the upkeep, everything. If the rents that you put out there cover that and it doesn't come out of your pocket, you're fine because you know now real estate runs in cycles. So you're just going to run in cycles. And how long do you think you want to hang on to any of your investment properties you have now or in the future?
I want to pass them down to our children.
So you want to keep them 30, 40, 50 years.
Yep.
Okay. And again, I want people to learn on this lesson. Yes and no on that theory. At 29, so if I ask myself at 60, what would I tell my 29-year-old self? Using real estate to leverage to build wealth is an awesome tool. When you're young as you are, 29, or if you wanted to make those and would have made those decisions at 21, you likely would have bought lower end properties because you only were limited to $X. I believe I call it stair stepping my wealth.
Yep.
If I buy at 21 a $150,000 property and I own it for 7 years, I've cash flowed on it, so I've made a few bucks, maybe a couple of $1,000 a year, whatever it is. The tax benefits are huge, and it's appreciated, and now it's worth $300. It's doubled up in 7 years. And it's done more than that lately, but on average, that's what it does, right? I teach my students, it's time to sell, take that $300, go buy the $500,000 property, right? Own that $500 now, and you bought it at 21, at 28. Now at 28, you own it another 7 years. That $500,000 house is now worth $800, $900. If you can do that 3 to 4 times in your lifetime, that last house is paid for and it's worth over $1 million. Then if you held on to that $150,000 home, which is probably not in the greatest neighborhood in any given city, it's only going to grow to a certain point. It ain't growing anymore.
Agreed on that.
Right? So if you have the time, at your age you have the time, to stair step wealth like that, you could not only own your properties that have high value, which we're going to give you high rentals. I mean, $1 million home right now rents for $5,000-$6,000 a month, right? If you owned it outright and you had 3 of them, you're good.
Yep.
You know what I mean?
And that's so yes, I wasn't saying these particular properties that I have right now. I'm saying I'm looking to continue on that legacy, how you exactly explained it, that snowball, the stepping stones. 1031, each one of these
1031 then, baby.
Keep growing them. Exactly what you were just saying.
We just did a sale on a 1031 property for, I think she's 78 years old. She's still 1031 money at 78.
That's awesome.
Because this is a mindset. Like, I don't want to pay taxes.
Yep.
I'm like, Mrs., so-and-so, you're 78, pay it. You don't need the money anyway, right? She's done very well. She's been in real estate her whole life. But now it's just, she's always done it. Like, all right, 1031. I mean, whether you pay it now or when you pass, it's going to get paid.
Of course. It's
going to get paid. And in your case, I mean, you'll have someone to, pass it down to, right? If you're going to have kids or your wife or whoever. The tax man comes and gets it sooner or later.
Always do.
Always do. We can't run from it. We can kind of, kick the can down the road a little bit, but we can't run from it. How often do you talk about money to your peers? Do you get in money conversations?
Often.
Well, outside of, not because I know what you do for a living, so you have to talk about money with clients, right? But your peers, your friends, how often do you talk about money?
Often, actually.
What do you guys actually talk about?
So I have a few friends from college, good friends. A couple of them starting businesses. A few of them working great jobs. And we just speak about what to do with money, what they've been doing with money, and where they're at situationally. We just that's what we've grown up doing in that space at Syracuse. That's something we started back then, and we've just continued it on. Kudos
to you. I wish more people your age would. Do you come across people that you find if you start to talk about money, you can tell they're uncomfortable and they don't want to talk about money?
Yes, often.
Often, right?
Often.
No, but if you got a little small circle where you guys still stay in touch and do little mini masterminds, you know, hey, Bob, hey, Joey, man, I'm doing this, I'm doing that. And they tell you, and you're like, really? How'd you do that? Right? And you ask questions and they ask questions. You guys learn from each other. Guys, for you out there listening, start talking to your friends. I find 99% of people will talk to you about money. There's people out there that'll tell you, I'm not talking to money about you, because they were taught by their parents, don't ever tell anybody about your money. It's nobody's business, your money. Yes and no. It's nobody's business how much money's in your account. It's nobody's business exactly what your bills are. I'm not saying that that's one of the conversations I'm wanting people to talk about. I want people to talk about the money lessons. Hey, I lost money doing X, Y, Z. You could tell the dollar amount. It's up to you. But the fact that you lost money, right? Well, what'd you do? Because I don't want to do that. You know what I mean?
Use it as learning experience.
Or the opposite, dude. I just put money. I did this, and it's really paying off for me. And they're like, explain, tell me. I got some extra money. I want to put money to work. What'd you do?
Yeah.
You know what I mean? The fact that you do that is really cool. So, man, keep doing that. And especially outside of work. Again, you work in an industry where you have to know people's. You're like a doctor, right?
Yes. We know a lot.
You got to show the doctor everything.
Yes.
Right. So financially, you're a financial doctor, and people have to tell you everything to find out if they, qualify for a loan. Awesome talking to you here today. I think some great feedback today. One, I really want to commend you. You are one of few people that I've talked to in your age bracket where you really took hold of the money lessons, even though they were small money lessons early in life, and you ran with them. So you were definitely surrounded yourself with some good, solid people. Unfortunately, you have people that don't surround themselves with the right people. And you've heard the term, you are the 5 people you hang with.
Yes.
And I tell people so much, I'm like, sometimes you just have to clean house, guys. Yeah. Have you ever had to clean house?
Yes. Yes, I have. A couple of times, actually.
Is it easy?
Yes, it's actually pretty easy. Once you realize how they are dragging you down, again, it's a reflection period. As I said, I like to reflect on what I do. Mm-hmm. So the reflection period is like, oh, that can happen again. I need to make room for myself and find new people to hang out with that inspire me, or these are the connections that I need to make.
What would you say to somebody out there listening saying, this dude's been my friend for 30 years, I can't kick him out of my circle? What would you say to him? But we know that person's not elevating you, and that they're actually a negative downer person. How would you explain to get that person out of that circle?
Interesting question. So I wouldn't say that you need to kick them out. What you would do is place them to the side. You need to find a new group of friends that you keep a little bit closer than that person. If that person is dragging you down, you don't want to see them every day. You may see them once a quarter, once every 6 months. They're still your friend, but you realize that's not the person that you want to surround yourself with on a regular basis.
Perfect. That's exactly what I was trying to pull out of you, because I wanted the audience to hear it from you and not from me, because I'm always teaching. That perspective, guys, if you heard what Jordan just told you, it's not to tell you have to tell that friend, you can't be my friend anymore. I never want to see or speak to you. And they didn't do anything, stupid. No, that's not what it means. It means you're not the regular dude I'm seeing every week. You're not the dude I'm going to be talking to about my intimate stuff, especially my monies, right? I don't want to hear your, stories of, I got drunk 4 times this week or whatever, right? And just not doing the right things. But we have friendships that we've had. I mean, I have 50-year-old friendships. But like you say, you start to distance, and it's not every week. And it's not something that you cut somebody off overnight either. It's just they realize, and I haven't heard from Jordan in a couple of months. They may call you, hey, what's up, bro? And you're like, nah, just working, man. What's going on, right? You're cool. You're casual. You don't
still the same
You don't
guy.
really let them know, bro, you're out of my top 5. In the Fockers, you're out of the circle.
Yeah.
Right? But essentially they are, because we need to understand you cannot be the smartest person in the room.
Yes.
If you are, you're in the wrong room.
Agreed.
And you got to move to the next upper room.
You have to grow.
You have to. You have to if you want to reach these goals. Man, today, I hope if you tell me, what's your biggest takeaway from our conversation today?
Continue to learn from Dave Ramsey, Tony Robbins, as you said. Write down the goals as well. Continue to get back onto that wheel. I used to write them down daily. Need to get back on that. Just projecting myself and having a clear picture of where we want to go, and then make a little roadmap towards it. Yes, it's not going to be straight and narrow. Yes, it's not going to be the way you want it to go, but if you have an end goal and you have little goals to get to it, you may take a left turn here, but then you get right back on your road.
Yeah, I mean, guys, our goals are going to change throughout our lives. For sure, 100%. Your goals at 20 or 21 are not the same goals when you're 30.
Yeah.
Trust me, they're not going to be. And especially you get married and then have kids, your goals are always going to change. It's more about creating the habit than it is the actual journey to get to that goal, creating that habit of writing them down, studying them, and looking at them. Doesn't have to be daily. I like weekly for sure, right? And sitting down monthly with your spouse. Hey, how are we on track, right? Everybody likes or should keep track of their balance in their bank accounts. Well, keep a balance on your life account, right? Where are we? Are we growing this life that we're cruising through? I'm glad that was your big lesson. I was hoping it was going to be.
Yes.
Yeah. Well, today was awesome talking with Jordan. His takeaway, guys, get them goals, write them down, follow them through. That's your roadmap for life, guys. Those goals are going to do it. I promise you that if you do that, you will see success in your life for sure. It's already proven fact. They've already done studies. It's not me telling you. Let's listen to the experts. So if you like what you heard today, listen, do me a favor. You're on YouTube. Subscribe to my channel on the podcast. Keep following me. Remember, I try to put them out every week for you guys to listen to the new ones. And don't forget, I also have that program available. Go to moneyconversationswithkj.com. You'll see my website in there and learn all about it. Small investment for you guys to really get yourself to the next level, learning all about financial literacy. And let's spread the word, Jordan. Spread the word. Talk about money. We can't be afraid. Thanks for coming out today.
Thank you for having me.
All right, guys. I'll see you guys next week. Until then, have a great week. Hey, everybody. Hope you enjoyed that episode. Really enjoyed making all these episodes for you. Remember, we're just having conversations with people's journey with money and the things they did right with it, the things that did wrong with it, and how did they really come about getting their mindset with money. So every episode's different. We all have a good takeaway from them. So do me a favor. Hit the like button, smash the like button, and subscribe to my channel because every episode that I do is going to be different as all our journeys are different. So you guys take care, and we'll talk to you next week.